Hello, this is Bruce Wan, Head of Research for MaxCap Group. In this video, I want to take a good look at the private real estate credit market in Australia and some of the popular myths that surrounds it. Certainly, this nascent sector is not well understood by anyone outside of it, but we can address that today. There are some common misconceptions that we often hear saying how the private credit market here is too small, too risky, too opaque, and also too easy. Let us tackle these one at a time. In terms of size, Australia is indeed a mid-sized economy with a small population base, but there are sizable opportunities here, and more importantly, there is a lot of market growth ahead. Looking at this table, we can see the Australian lending market separated into banking and non-banking components, along with funding for commercial real estate and for corporate and other sectors. For the overall market, there is respectable growth in the lending pool, reflecting the steady growth and the persistent inflation in the underlying economy. For the commercial real estate sector, there is even more growth there, given the relentless demand for housing developments to catch up with the robust pace of population growth in this country. For the non-bank sector, this is where we're seeing the strongest growth, at a pace that is doubling the market size every 3 years as lending activity migrate from banks to non-banks because of the strong demand for funding, the demand for flexibility, and the banking regulatory framework. In terms of risk, there are a lot of adverse headlines about the volatility of the construction sector, particularly with the recent round of builder failures reported over the past 2 years. In our view, the construction sector is set to improve steadily from here as costs stabilise, selling prices continue to rise, and profit margins start to widen again. However, all things considered, the realised risks for private commercial real estate debt are still extremely low. This is evidenced by the strong pace of returns, the low degree of volatility, and the low instances of drawdowns, not just this year, but year in, year out over the past decade. In terms of transparency, there are definitely a lot more we can do to reassure investors and regulators about the degree of risk in this market segment. For investors, there is great value in seeing and understanding a manager's historical track record, to see how often loans are repaid, how assets are repossessed, and how bad loans are worked out. For regulators who are tasked with limiting financial contagion risk and protecting superannuation account holders, we see great benefits from more transparent reporting and greater accountability. In terms of accessibility, there is a big influx of new capital and new managers right now thinking it's easy to make money in this segment, but that is not always the case. The reality is there is a highly specialised skill set for success in private commercial real estate debt. It needs a lot of experience and a lot of expertise to oversee builders, review costs, and manage schedules. At the same time, there are long-standing relationships that add barriers to entries in this space. This works very well in favour of established lenders, especially those with close relationships to strong sponsors with strong balance sheets. You can read more about this in our latest report. If you want to discuss the potential opportunities in this space, talk to us in our capital team for more information. This has been Bruce Wan for MaxCap Group.